In today's economy, more people than ever are looking to buy and sell businesses. But how do you do it? Welcome to the Deal Board, presented by Transworld Business Advisors. Straight talk about real deals and real people. Listen to stories, interviews, and expert advice to help your business sale, merger, or acquisition process. Now, here are your business exit experts, Andy and Jessica.
All right, welcome back, and thanks for joining us again. Today, we're going to talk about recasting financials. And if you haven't listened to our valuation podcast yet, stop this recording and jump back and just listen to that valuation podcast first, because we're going to reference a few things that we talked about there. And this is kind of like the part 2 of how we calculate what businesses are worth. And just a reminder for everybody too, we're talking about small deals here. So we're really talking about small businesses and businesses that are earning less than $1 million a year in EBITDA. So that's kind of what our focus is going to be on. And we're going to just push the large deals aside for a moment for this podcast. Transworld Business Advisors is the world's largest business brokerage and mergers and acquisitions firm with over 500 brokers in nearly 200 offices worldwide. Transworld's team handles thousands of business sales every year. To be connected with a qualified business broker or learn more about the buying and selling process, visit tworld.com/the deal board or call 888-719-9098. Andy, you want to talk about what the goal of recasting is and actually what recasting even is, since we haven't defined it yet?
Yeah, so recasting is looking at someone's financials. And the goal of everyone's financials is usually taxable income for taxable avoidance purposes, right? So everybody's setting up their income statements to have as little income as possible. And, you know, there are many ways to do that. Many of them are legal. Some of them perhaps are pushing the envelope out there in the world as far as hiding money from government entities. And we're talking internationally too. So this happens all over the world. And so the idea is then to take those financials, profit and loss statements, and sometimes balance sheets, and recast them to show a buyer what they're getting. I mean, you know, that they're getting not a tax avoidance profit and loss, but what actually the business is making. And seller's discretionary earnings, or SDE, and it's called many things, SDE, DE, adjusted net. I hate that they use sometimes the word cash flow, because cash flow is different than earnings, but sometimes they use seller discretionary cash flow or just adjusted cash flow. It's called by many, owner benefit. It's called by many names. But at the end of the day, what a broker, a business broker, or even a seller is trying to show the buyer all the money that's available to them to either pay themselves a salary, perhaps service debt service for the purchasing of the business, and perhaps buy things that they need, you know, balance sheet items, you know, equipment, things like that might not hit the P&L. So we're trying to recast the financial to show all the available monies that would be for a working owner operator. And we'll talk a little bit more about that in a second. But that's the goal. And the goal is to be able to compare it to other businesses, right?
Right. Yeah. It's trying to get a baseline. So when a buyer is looking at different businesses, they can look at a comparison and kind of, you know, a 1-to-1 ratio, or one business is similar to the other business. And, you know, ultimately every business owner runs companies differently too. So this recasting gets it to a baseline level and then lets the new owner structure how they're going to take money out of the business in a different way. So I guess we can kind of kick it off, and, you know, we have a recasting cheat sheet that we use, but some of these expenses that are added back. So we start with the net profit, and now we're adding back expenses. And some of the definition ones that are easy is we talked about EBITDA, but, you know, adding back interest, taxes, depreciation and amortization right off the bat. And then, like you said, Andy, too, in our valuation podcast, that we're going to add back an officer's salary, but for only one officer, right? So what happens if there's multiple owners in a business, like a husband and wife working a business together? Can you add back both salaries, or it's just for one person?
No, obviously, we again, to try to be consistent across the board, it's only for one owner operator. So, you know, listen, we sometimes walk into a business and, you know, the owner's standing there and there's somebody else working in the business that they're paying a salary to, and there's 3 partners that they're paying salaries to. And if one buyer buys that business, they're obviously going to have to replace those people. Maybe someone's the CFO or the bookkeeper, maybe someone is a salesperson or a technician. So again, we would recast the financial to show that we would have to replace it. We would add back and we talk about add back or adjusting. That's sort of the same thing, but we adjust the expense down to 0. And then we would, normalize if we had to hire those other people.
Right. And so we're going to do that for one officer's salary, and then also do the same for the payroll taxes and any, you know, pension or health care that goes along with that one owner's salary as well.
Right. And then
So,
sometimes they don't pay people. We should cover that
yeah,
real
that's
quick.
true too.
Right. So
Yeah, sometimes, yeah, your wife's not getting paid to work in the business. She's just supposed to show up every day, right?
right. Or the kids are there. You walk
Yeah.
into the restaurant and like, oh, who's that maitre d'? Well, that's my daughter. Does she get paid? No, she gets to live in the house. And who's washing the dishes? That's my son. Does he get paid? No, he gets to live in the house. So, a business like that where the owner perhaps is paying themselves $100,000 or making SDE of $100,000, are they really making that kind of money? It's like, no, you would have to replace those people. So again, it's one owner operate. And if a business is being run absentee, if somebody owns multiple businesses and they're selling one location, we would add back the manager's salary because we expect the buyer, whoever is buying the business, to work full time. And that's 40 hours a week. That's not 120 hours a week. It's one owner operator full time.
So, what other would you say recasting items that are most typical in a business? We've got a lot of different other items, but some of the essential ones that we're going to add back. Have we covered most of them, or are there any of those that we should still cover or we've missed?
Yeah, well, listen, there's the typical ones that we see in small business where the owner is writing off their auto expense, perhaps. So, they're writing off a personal auto and the expenses associated with an automobile, including insurance. So, we would look back at now. Again, the auto has to be personal in nature. If you're a contractor and you're using the you drive your truck to work every day and the owner's going to need that truck because it carries all the tools, that's not a personal vehicle. But if we had an office supplies business where they were leasing 2 Mercedes Benzes, I mean, that's personal in nature.
Yeah. And I think, from here on out, we're getting into that gray area where you really, if you're adding any of this stuff back or adjusting these expenses, documentation is key because the buyer is going to start to question some of these additional add backs or adjustments and ultimately to the bank, right? So if it's a bank financing deal, some of these adjustments won't be accepted by the bank, but with proper documentation, there can be some arguments made for special cases.
Yeah, the banks, like as we say, the front page of the tax returns. They're going to look at the interest, taxes, depreciation, amortization, and we add those back automatically. And again, that's showing the business debt free. And so the banks take that because they know that money will be available to pay them. But once you start getting into health insurance and cars and all kinds of things that we're about to talk about, the banks are like, well, maybe the new owner is going to want those things too, and that won't be money we're going to be able to use, or the owner will be able to use to pay us back. So banks like the front page of the tax return because that's where you see interest, that's where you see depreciation, that's where you see the officer's salary. So that's right on the front page.
So some of those other items that we can talk about that we can add back that aren't on the front page could be adjustments for any real estate expenses too. And I know we talked in our leasing podcast that sometimes you have to adjust any real estate expenses or adjust it to market rent if the owner owns the property and isn't paying themselves market rent. So that's a big adjustment to make too.
Yeah, actually, we've seen times where people aren't paying rent.
Right. At all.
Yeah, at all. So it's not even on their P&L. So they're on a cash basis. So if somebody owns the real estate, if the corporation owns the real estate, or they own the real estate in another corporation and they're not paying themselves market rent, we have to adjust to market rent and apply it. And listen, we just had a business that came through the other day that if we applied market rent to this business, it wouldn't make any money. So,
Yeah.
so in that case, the landlord, the seller said, "What do we do?" And we said, "Hey, listen, what you could do is perhaps have the give the new buyer a sweetheart lease for 3 years, and then they could afford the business." So real estate is important. We take out all the expenses of the real estate and apply a market rent.
Yeah. And sometimes even have to, if they don't own the real estate, adjust the rent based on if the rent is going to increase or decrease, or if we expect that number to change through the sale process, which again, we talked about in our lease and landlord podcast, which is one of the bigger issues that we're having with deals right now. Um, Also, there's the whole donation issue too. If, you're adding back some of those non-business donations that people just choose to do, which is great, but those are typically recasted or added back as
Right.
well
I mean,
during the
and
process.
donations could be a business expense, right? So I had
Yeah.
someone whose number one customer was 75% of their sales, ran a golf tournament every year, and they sponsored the golf tournament for $15,000 a year. And they wanted to add that back or adjust that out. And I'm like, that's a real business expense.
Yeah,
I
that's real.
think
Yeah.
your number one
Generating
customer
clients.
might be mad at you.
Hey, Andy, you know what time I think it is? I think it's time to talk about our deal of the week.
Deal of the week. Hey, we're here with Nate Ernest Jones, and we're talking about a great deal of the week, a very interesting business, and a lifestyle business, as well as a very profitable one. So, Nate, why don't you tell us about this latest sale?
Sure, happy to. So this is a dive store, as it's known in the industry. It's a scuba diving retail operation that focuses on all things scuba related, such as the tanks and flippers, wetsuits, all the fun stuff associated with diving. In addition, they also accommodate excursions. So people in the looking to get further into diving, or people who are already certified, they'll organize trips out to various locations. So it's an interesting business. It's a fun business. And so I think a couple of the interesting things that I would point out, particularly about lifestyle businesses, is they do garner a lot of attention from the buying community, let's call it. People think it's a fun business, and it can be very fun, but at the end of the day, it's still a business, and you still have employees and rent and insurance and all expenses associated with running a successful business. So it can be difficult to identify the ultimate buyer. What was interesting about this particular sale, and just to give you some metrics on this business, good history to it, fairly good books and records. I wouldn't call it impeccable, but given the geography of the business, this one happens to be in Miami. There, it was a bit of a rocky history in the past, probably 2 to 3 years leading up to the sale. So it wasn't quote unquote easy taking this to market. But we did have quite a bit of interest, and the business probably netted around 220, and we were asking 695, so just over 3 times multiple. There was just shy of 200,000 of inventory included in the purchase. We had this under contract, and it fell apart for a couple of different reasons. But really, what I want to go into is who ultimately bought the business, and that was an employee of the company. So you could almost look at this as, why if you are a seller and you have a good amount of employees, you obviously want to keep that confidential from them, but there is a possibility that the employee could be the perfect buyer for that business. So this happened to be a new employee, and the way it transpired was the owner was approached by the employee who asked, "Are you guys selling the business?" So any owner would be kind of taken off guard by that. And I thought the owner answered it pretty well, which was, "Well, not actively, but we have been approached by someone interested in purchasing it. And we're always open to those kind of conversations. So the employee said, "Can you throw my name in the hat?" Now, this is an employee making probably $20 an hour, and asking the owner to consider him as a potential purchaser, of a $700,000 business. So, he quite rightfully he said, "I'm not sure you can afford this kind of business." But as it turned out, this particular employee had a lot of family and friends' money behind him, and so he was in fact able to afford this business. But notwithstanding of that fact, one thing to also consider is that there's financing available. And in this particular business, we were able to get financing. And, most of the financing that you see in small businesses, SBA loans, an SBA loan would apply for this kind of business. So although it was a little bit of a shock to the owners at first, and they were very trepidatious about whether or not to open the kimono, so to speak, to an employee, um, it it was in fact a great fit, and it was in fact a successful sale at the end.
Well, that's a great story. And, we got sometimes again, good deals for good people. This new employee turned out to be the perfect buyer. And the seller's dad stood up and, wound up helping the buyer, helping the kid purchase the business. So great story all around. Good deals for good people. Thanks, Nate.
So, I think some of the big category too is that non-recurring or one-time big expense. Like we've seen, unfortunately, business owners get divorced sometimes during the sale process and running through some legal bills and legal costs through the business. So that's it's a personal expense, but it's also one-time, non-recurring, any type of big legal case, something like that, or insurance payments, all that needs to be adjusted out.
Yeah, and employee theft. And, again, we're just trying to get to, the whole idea of recasting is not only showing what a buyer is going to earn based on these it is what's showing what the buyer is going to earn in the future, right? So we're relying on past financials to predict the future. So we're trying to adjust these financials to show a complete picture of what the business may look like going forward for the buyer, all the monies that are available to them. So, all those one-time things could happen, and like customer loss or gain, right? So all of a sudden, they lost their biggest customer. Well, guess what? We're going to have to recast that, even their sales down to have an accurate depiction of what might happen moving forward. Now, if they all of a sudden got a big customer in, so halfway through the year, perhaps we could, recast the financials to show what the business will now be like because of that brand new contract or customer. So there's lots of things we could do to, try to accurately show a buyer what they're buying.
So the end of all this, we have this SD number that's presented to a buyer, and as a buyer, you want to take a look at the calculation that the broker or the owner makes, and that's typically going to be, in the pitch deck, executive summary. You're going to review it in a meeting with your broker, but you want to ask about any large number that you see on that recasting sheet, and look for some reasoning behind it, documentation, things like that we mentioned. What about like on the seller side, Andy? What advice would you give to them about this process and maybe preparing to sell a year or two in advance?
Well, again, if we just talked about it in a different podcast, valuation, and if businesses are selling for 2 to 3 times, every dollar that you're hiding or badly hiding, or, you want to show the business and, making money. So every dollar that we could find could turn into $2 to $3 in sale price. And every dollar that the buyer could find, they could turn it into perhaps a loan that they could leverage. So all these things are very important. So if you're running your business, number one, try to have clean books and records going into this. And we'll talk more about, quality of books and records, perhaps in another podcast. But for recasting purposes, you want to try to make it as clean as possible so people can find the money. And we'll have some examples either in moving forward of all the crazy things people do to hide the money, right? And some of them are easy to unwind, and some of them are impossible to unwind. So we really want, you want these clean recasts, and we want all of the business brokers and all the sellers out there who are bringing businesses to market to do it the same way, so we can have buyers compare investment opportunities.
Right. Yeah. And, ultimately, I think when you're talking to sellers, you're saying, we're looking back at 3 years of financials. So the cleaner the books and records are for the past 3 years, the more we can get to that apples to apples comparison.
Yeah, and businesses change value very quickly, right? So if they
Yeah.
lose a big customer tomorrow and it, was 50% of their sales, guess what? Their business may have gone down 50% in value in one day. Because again, value is based on future income. We're using the past to predict the future, but if it's not going to happen again because of something happening, out there in the world or something that happened in their business, it's going to affect the value right away. So, you know, again, we're recasting, trying to find, the future bottom line, and it's hopefully indicative of what's happened in the past. And you don't want to overreach on this kind of stuff, right? Because we're going into
Right. Not at all.
right. We go into due diligence, and what happens?
And the buyer's just going to question everything. And if we can't provide a good reasoning for an add back, the deal's either going to, one, could fall apart, or two, it could get retraded and the price could decrease.
Right. And that, we always say, one of our famous things is, Tom Jones says it all the time, the seeds of inconsistency grow, right? So when they find one
Right.
little inconsistency in a recast, that means the whole recast is subject. And we don't want to do that. So we all want to be very conservative in our recast. So sometimes, people are running their family telephone through. Should we add that back? I mean, we can if it's a huge number, but, perhaps some of it is left to quote unquote, like a little cushion room. Hey, Jessica, you know what time it is?
Money time?
Almost. It's time for listing of the week. And we're here with Tom Milana again, and we're here to talk about the listing of the week. This is a really nice deal. And I always like, construction is hot and service businesses are always sought after and always needed here, especially in South Florida where it's hot. We're going to talk about an HVAC business.
Yeah, Andy, thank you very much. We just listed a well-established air conditioning company here in the Fort Lauderdale area. They've been around for about 10 years. They have about 5 trucks on the road. The business is going to do about $2 million in volume this year. About 60% of that is residential volume. And the business is going to do about $250,000 in owner's benefit. As such, the price is $750,000, and the business is SBA pre-qualified, and a qualified buyer would only need about 10% down.
That's a good deal. And the SBA lender has qualified that, not quite the SBA, but the SBA program. It's a great program to get into deals like this. And wow, $75,000 down. Talk about expanding your business. For $75,000 down, we're at $250,000 seller's discretionary earnings coming right to that new business owner or to the new business acquirer if they already owned an HVAC business. Tom, great deal. Thanks.
So I guess the one big thing we haven't talked about in this podcast yet when it comes to recasting is kind of a big elephant in the room. But what about cash that's not reported through the business and through the tax returns?
Yeah. So I once upon a time wrote an article for the IBBA, the International Business Brokers Association, and I was talking about the myths of business brokerage. And one of the myths I think out there is that businesses that hide cash cannot get the value out of the cash. And I think that's a myth. I mean, we've seen plenty of businesses that are quote unquote cash based that sell, like laundromats, historically cash based laundromats and things like that. But guess what's happening out there in the world? Well, what's happening is there's less cash out there in the world, right? And why is there less
Right.
cash?
Because, there's credit cards and everybody's paying by credit card.
Right. So everybody's paying by credit card now. I have a business owner that owns restaurants. He said he's lucky to get 10% cash out there in the world because everybody's running credit cards, and now they're making credit cards super easy to use. The transactions are fast. Now you stick your credit card into the machine and it does it automatically. You
Or
can
even like swipe your phone if you don't have your wallet on you.
swipe your phone. It's happening automatically. I mean, and then there's apps. Starbucks has made it so easy to buy stuff there, and Uber has made it so easy to take a ride. So I think we're going to see more and more of that. So the good news is cash isn't affecting things the way it used to. And I say that, and then all of a sudden my boys from New York say, not New York, Andy.
Yeah, well, New York's a little bit of a different market. But, I think you're right. I think, if there's cash not reported through the business, it's harder to get paid on that cash, but there's ways to do it. And the guys in New York actually have some creative ways of looking at, cost of goods sold, or I know there's even been people that have sat and watched customers enter and leave the business. So there's all kinds of different ways to calculate it.
And even if there's cash these days, in a lot of businesses, it's being recorded. Why? Because people now have point of sale systems. Even historically cash businesses like a convenience store. Well, the convenience stores these days all have a point of sale system where they bring the inventory in, check it in through the computer. It's in the computer and it gets checked out through the computer through a scanning. So I think even historically cash businesses are becoming you know the other thing that people try to cheat on, even in businesses that aren't cash, at the end of the year, if they're on cash basis accounting, they try to hide the income by not cashing checks or holding off checks to the end of the year. I think that's changing because everybody's paying online. There's
Yeah.
ACHing things
Yep.
or automatically. So the world is changing as far as cash is concerned, but it is still an issue. And, again, we're all trying to recast the same way. And so if there's a significant amount of cash in the business, I think you'll see brokers try to explain that somehow in the recast, and maybe put it on the top line and say, hey, this extra income, and this is where it's happening and why it's happening. And then sometimes they'll just ignore it.
Yeah, I guess it ultimately depends on how big of a recasting item it is.
Right.
So we've gone through some pretty big pieces of the recast, and ultimately we're trying to get to that SDE number and get back to the valuation, which again, if you haven't listened to the valuation podcast, you should really jump in and listen to that one. But any parting words of wisdom for sellers or buyers?
Yeah, I think, and I'll even say to the brokers out there in the world, is the more transparency we could have for buyers and sellers, and have more consistency on how we recast financials, and show businesses, so they can be compared. And when we get to do due diligence, these deals aren't blowing up because there are inconsistencies, or over aggressiveness, or hiding of income that just isn't there. I think if we all work together to make sure that these recasts are done on a consistent basis, and you truly have a 3-column spreadsheet. You have the tax returns, you have a middle column where you're adjusting the items, you have a reason why you're adjusting the items, and you have a quote unquote ending P&L statement that has been adjusted, that gives you that true owner benefit, SDE, that the buyers can rely upon to make informed decisions on how to buy business.
Yeah. So I hope this podcast was helpful for everybody. And, we'll put some additional resources in the show notes. But as always, if you have questions, reach out to us, ask the brokers that you're working with, and, try and have a good understanding of this whole recasting and valuation process, because it really is the key to success in a transaction.
And I'll add one thing at the end. Don't expect to be able to do due diligence before you make an offer. So you're going to get a recast. You should be able to see how they recasted the financials and get a representation of the income statement and how they adjusted it. But don't expect to be able to tear through a business's and go into a full due diligence until you have an accepted offer on both sides.
Yeah. Yeah. And we'll definitely cover in a future podcast kind of an overview of the buyer's process and how that lines up. But yeah, due diligence is the time for that after your offer is accepted.
Great. I think we handled this pretty well.
Yeah, definitely.
Okay.
Hope that was helpful for everybody. And we'll join you on the next podcast.
See you soon. Thanks for tuning into our show today. If you like the podcast, don't forget to subscribe through your favorite podcasting app and leave us a review. If you have questions or suggestions for the show, visit us at tworld/thedealboard or email us at thedealboard@tworld.com.